Chapter 11 will talk about property, plant, and equipment, and specifically how we charge those off to expense over their service lives. So first we have, figuring out, okay, what are we talking about? So do we have property, plant, and equipment? Do we have natural resources? Do we have intangible assets? And we'll talk a little bit about each one of them. And then we have to figure out, okay, how are we going to allocate those costs over the periods that benefit? So they give us an example, like if we have a delivery truck that's $82,000, we think it's going to last for 5 years, at which time then we think we can either sell it or trade it in for $22,000. So then the cost that we want to try to charge off to expense is going to be the $60,000. So the $82,000 minus what we think we'll get back at the end. So we're going to take that $60,000 and split it out over those 5 years that we are using that truck. So these are the things that we have to consider: the service life, how long are we going to use it? What, again, is that allocation base? So the cost less what we expect to get back at the end. And then how are we going to choose to allocate it? We'll see that there's a few different ways that we can do it. So our service life, again, is the time that we're going to use it for. So, again, and it doesn't necessarily have to be its entire physical life, but we should try to make the best estimate of what we think. Like, how long are we really, like with this delivery truck, how many years do we really think we will use it before we end up getting a new one? So that allocation base is that initial value when we acquire it, less what we think we'll get back at the end. And again, that is also an estimate. We don't know for certain, but that's what we're going to estimate it, so that we know that we are going to charge off the rest to expense over its life. So we can use a time-based one to say, like, we're going to reduce that value as time goes on. So if it's over those 5 years, we could choose to do the exact same amount every 5 years. Or it could be activity-based to say, well, as we use it, we're going to use it up. So with that delivery truck, it'd be as we drive miles on it, it's going to get used up. So our time-based methods are our straight line, which is the easiest and by far the most commonly used in financial statements. And then we have accelerated methods, which are the double declining balance method and the sum of the years digits method. Those are two ones that are the common ones to use. So basically, I think this first little bullet point here is just explaining what that is that we're going to just charge higher depreciation in the earlier years of the asset's life and then lower depreciation in the later years. Like if we were comparing it to straight line is the exact same amount every year. Accelerated methods is more at the beginning, less at the end. Units of production is going to be based on how much we use it. So like I said, with that delivery truck, it'd be how many miles do we drive? And then if you think about it, that's probably the most accurate, using it up. The more miles you drive, the more you use it up. But again, straight line is by far the most common. So here they give us an example. So if we have a cost of $250,000, a residual value of $40,000, and we estimate that we're going to use it for 5 years, we're going to just take the $210,000 allocation base, divide that by 5, and that gives us $42,000 a year. So then you can see it's exact same amount every year. Our accumulated depreciation goes up by that $42,000 every year. Our book value goes down by the $42,000 every year. And then at the end of the service life, we'll have that $40,000 that we estimate that we're going to get when we trade it in or when we sell it. So then our journal entry, every year is going to be to debit depreciation expense for $42,000 and then credit accumulated depreciation. So the double declining balance method, same scenario, but now what we do is we calculate out our straight line rate. So that's what this 20% is. So we've got a 5-year useful life. 1 divided by 5 gives us 0.2 or 20%. That is what they call the straight line rate. We're going to take that times 2. and that'll give us our double declining rate. So our double declining rate is 40%. Now notice you don't factor in the salvage value at the start. You go to what is the cost, take 40% of that. That's what I'm going to depreciate. That's what goes into my accumulated depreciation. And then my book value then goes down to 150. Then year 2, I take 40% of that book value. So that's 60,000. So my accumulated depreciation goes up, my book value goes down. Then year 3, I do the 40% of that. I get 36,000. And then my book value goes to 54. Now then you'll reach a point where you don't do the 40% anymore because you don't want it to go below the residual value. So we'll look at this year and say, okay, well, if we did the 40%, we would end up with a higher number. We would depreciate it too far, and we don't want to do that. So all that's left to depreciate is 14,000, and then we would have nothing in year 5. And then our book value is 40, and that's again what we expect to get when we sell it or trade it in. Some of the year's digits, I feel like nobody does this, but I can't rule out that it couldn't possibly be a question somewhere in your quiz or your test or your homework. So we'll just show it. So what the sum of the year's digit is it's a 5-year useful life. So if you take 1 plus 2 plus 3 plus 4 plus 5, you get 15. Then you take it to say, okay, in my first year, I have 5 years left. So 5 divided by 15 is the rate that I'm going to take the depreciation. Then in year 2, I got 4 years left. So 4 divided by 15 is the rate that I'm going to take depreciation. So you do that every year, and then notice your depreciation expense again is higher in those first years, lower in the last years. And then also notice though you are using that depreciable base. So in double declining, you use the 250 and then you stop at the 40,000. This one you do use the 210 and you'll end up ending at the 40,000. Then our activity base, again, I always think this one is probably the most accurate. People don't necessarily use it, though it's also not very common, but it does seem more like practical. So these are the miles that this is the machine. These are the hours that this machine, or the units that this machine has produced every year. So the more they produce, that means the more you ran that machine, so the more depreciation expense that's going to be taken. So you take the total estimated production of $140,000 units, and you divide that into that depreciable base. So the 250,000 minus the 40,000, or the 210 divided by 140,000 units gives us $1.50 per unit. Then each year you take the units produced and multiply them by the $1.50, and that will give you your depreciation expense. And again, because we've already subtracted the salvage value up here, after we allocate that out to all of our units, we'll end at the 40. But this is another one where you'll get down to that 5th year, because again, this 140,000 units is an estimate. We really may do more or less than that. So we just want to make sure that our final year we end up at the 40,000. So that's why this 24,000 is in pink, because it isn't just the 26,000 times $1.50. It's saying this is where we have to stop because we want our 40,000 to be in our salvage value. So you can see here as we compare them, all methods are actually generally accepted accounting principles, and all methods we end up depreciating out the 210,000, or that depreciable base. It's just how much goes into what years. So you can eyeball those to see, again, they're inconsistent, and some of them have more in those first years, and some of them have a little bit less, again, depending. So then this again shows you how much more common. So like I said, literally nobody uses the sum of the year's digits, but almost everybody uses straight line. And then units of production would be next. Now we'll talk about the group and composite. It's instead of doing individual assets, you group them by what type of assets they are, which does seem like it would be a little bit simplified. So I can see why some companies choose to do that. So again, straight line is easy. It smooths the expense out over all of the years. There's no real fluctuations. The accelerated method, the reason people like that is because you'll get your tax benefits up front. You get to deduct more right away. And then, like I said, the activity based is actually just more accurate. Now, we can have times where we obviously don't buy the asset at the first of the year. So maybe we buy it in May or June or July. So we can do a half year convention to say that we're only going to take half of the year of depreciation in the year that we acquire it or in the year that we dispose of it, assuming that it's not at the beginning or the ending of the year. So then here again, they show us an example that we acquired it in April. So we're going to just, well, this is units of production, so it's kind of actual. So we actually only produce that many units in those first 8 months of using it. And then we actually produce these many units in our last 4 months of using it. But so when you go from the start date to the end date, you're still talking it's 5 years. You're just crossing over 2 different fiscal years. And then this shows you like if you were going to use the other method. So the straight line method, again, you bought it in April, so you would take 3/4 of the year. And then that when you were ending it, you would take the final quarter in that next year. The double declining balance, you would factor in that 3/4 at the beginning. And then the end, you still are just using a plug number to get to the 210. So this really isn't a computation. And possibly the same thing over here. We had the actual production, and then that bottom line number might be a plug because we can't take it more than we have to only depreciate up to the 210. Now then we can sell assets or dispose of assets at the end of their service life. If we do that, we have to record a gain or a loss. So we have our selling price. We're going to compare that to our net book value. And our net book value is our cost less our accumulated depreciation. If we sell it for more than that, we'll have a gain. If we sell it for less than that, we'll have a loss. So here we have an example. They had a machine that they bought in 2024. They expected it to go for 5 years, but it really did not. They ended up selling it 3 years later. So they sell it for $140,000. So we need to get it depreciated up to the date of the sale. So if we have the $250,000 that we paid less the $40,000 salvage value divided by the 5 years, that will be our annual depreciation. So we'll record that up to the date of the sale. And then we'll look at what is our accumulated depreciation total. So again, for 3 years. And then we'll calculate out our net book value. So then our net book value is going to be the $124,000. We compare that to the $140,000 that we are receiving, and we have a gain of the difference. So we have a gain of $16,000. So then when we do the journal entry, we got to record the cash, take the equipment off of the books by crediting it at its cost, take the accumulated depreciation off the books by debiting that, and then recording that gain on sale as a credit. If it was a loss, it would be a debit. Let's see if we have a loss. Yeah, so here we have a loss. So again, same scenario, but then now we receive a selling price of $110,000. So we compare that to our book value and we lost $14,000. So then we're gonna have the cash come in, take the asset off of the books by crediting the equipment, debiting the accumulated depreciation, and then now we would debit the loss. So a loss is debited, a gain is credited. So again, a gain is if we sell it for more, a loss is if we sell it for less than our book value. We can have assets that we are no longer using in the business and we are holding them for resale. So I mean, maybe we did it as a investment, maybe we just aren't ready to sell it quite yet. But then those assets, when we classify them as held for resale, we no longer depreciate them. So we hold them, and again, it's expected to be sold within the current year. It's not going to be like for a super long time. But then those we will not depreciate. Now we could just retire an asset, which means we're just going to kind of get rid of it, right? So maybe it's not worth selling. Maybe we don't have an open market to sell it in. So say it's an old computer, for instance, like we might just throw that away if it's broken and it's not worth the cost to repair it. So if you had a value left on your books, the asset less the depreciation, if there was a value left there, you would just have to write it off as a loss. But you do want to take it off of your book. So any asset that you're getting rid of, throwing away or scrapping, you definitely want to take it off your books and record that loss. Then this is that group method or that composite method. So we're organizing our assets by similar service lives or other types of similar attributes. And then we're going to depreciate the whole aggregate amount. So we're not doing it individually. So if we've got, they've got vans, trucks, and wagons, because they're a delivery company. So they're grouping them by their estimated service life, and then they're calculating just a annual depreciation based on that total group. Now then when so they give us the percentage because we'll use that. Okay, so let me get this up here. One more click, right? Yeah, so then the average service life is 5.15 years. The group depreciation rate is 16%. So then they'll use that 16% when they depreciate it. So then we'll add, like if we buy new assets or we sell new assets, they'll go in and out of those groups, but we're still going to just use that rate that we calculated for depreciation. So we won't normally have a gain or a loss, like when we're getting rid of one of those assets, it's just going to be kind of plus or minus. And then we take the total and multiply it by that percentage. So here, if it is, so if we have one that's sold, again, we receive the cash in, we take it out of our account at the historical cost, and then the difference all goes into accumulated depreciation. So we're kind of netting any gains or loss into that accumulated depreciation. So again, that might make it a little bit easier for companies to record some of that stuff. Okay, then we have depletion, which again, not all companies have it. If the company has natural resources, like an oil and gas company, they're going to have depletion on those natural resources. So we want to figure out what is our depletable base. So is there a residual value? So what are we paying to get this natural resource? Is there any residual value after we've pull this natural resource out of the ground? And then it's because sometimes there might not be, but there could be because the land could still have value. So whatever we're depleting out, we're going to figure that out in that depletion base, and then we're going to divide it by our estimated extractable units. So like in an oil and gas company, like I worked there, we did mostly natural gas. So we also didn't buy the land though, so there would have been no residual value. We would have had a cost to drill the well, and then we would have divided by how many MCFs we thought were inside that well, or that we could extract from it, and then that's what we would deplete. So then we're going to charge off depletion expense and then credit whatever that natural resource is. So here we have an example. This one is of a mine, right? A copper deposit. So they have all of these costs to operate that, or to get that mine where they could actually start to extract it. They did buy equipment. Now, if it's equipment that we can depreciate, that wouldn't be included in our depletion. So only the stuff that's part of the actual, like the ground or the digging of this mine shaft is going to be included in that. So we have the 2,768,360. We estimate that 1 million tons of copper will be extracted. So then we're going to calculate our rate, and our rate's going to be $2.77 per ton. So then in a year that 300,000 tons were extracted, we're going to take the 300,000 times that rate to calculate out what that depletion expense would be. And then we're going to reduce the value of the mine. So they could, some textbooks will show it going to like accumulated depletion. Other textbooks have it just going right to the asset. So a company could probably choose to do either one. Now then, that equipment that they purchased, again, it is separate from the well. So they're going to, or the mine in this case, so they're going to calculate their depreciable base. and then divide it by those million units. And then they're going to charge it off to depreciation expense as they're extracting those natural resources based again on the quantity. So then here we've got the 600,000 minus 60,000 residual value divided by the million tons. So 54 cents per ton. We multiply that by the 300,000 tons that were extracted. And then that's what we're going to charge off to our depreciation expense. Intangible assets, again, they may have specific useful lives kind of set up based on how long their legal protection is, if it's like a patent or something like that. There could be a residual value, but it might more than often be zero, because again, once you use up that patent, it's a protection of that process or that design or whatever. Once you use it up, it becomes public domain. So there's really no one who's going to purchase it once it's out of its contract life. So there's probably no residual value. And then we're going to amortize it out again over the period that we use it up. So amortization of those intangible assets, again, here's an example. We've got a $20,000 patent that is protected for 10 years. So then we're going to amortize that out at $20,000 a year, or sorry, that wasn't the patent, that was the franchise. Then we have a $50,000 patent that has a legal life of 13 years. However, we expect to only use it for 8. So we're going to use the 8 years that we're going to use it again, because we want to try to properly match it to the revenues that it creates. So we want to just use the period of time that we are using. And then again goes to amortization expense, and then we credit the value of that intangible asset. So now they decide to sell that patent. So again, or no, are they selling the franchise? What are they selling? Yeah, they're selling the patent. So they decide to sell the patent for $21,000. So the cash comes in. We're going to compare it to the net book value. So we started at 50. We've depreciated it for 5 out of the 8 years. So then we would have a gain then on the difference, because we got more than what was on our books. So software development, there's 2 different methods that they can use to amortize the cost of that software development, either straight line or a percentage of revenue method, whichever is greater. So they give us an example of that. So we have sales for the current year and then estimated sales for the future years. So 10 million over the 4 years. And they'd like to expense the $1,200,000 of costs incurred prior to the establishment of the technical feasibility, because that is what we talked about in a prior chapter. Any of those like R&D type expenses that is incurred before it, those get charged off to expense. The $800,000 is what you could capitalize and then charge that off to expense. So then our 2 methods, again, we could say straight line, which is 4 years, it's going to be $20,000 a year, or it could be percentage of revenue. So we estimated $10 million total. If there's 3 million this year, that would be 30%. And so we would go with the higher. So 240,000 is what we would amortize out, and then we would reduce those software development costs. There are some intangible assets that we don't amortize out because they don't end. So like goodwill, we are going to look at it to see if it's impaired. Trademarks and trade names last as long as that company's in business. So we normally do not amortize those out to expense. All right, then we can have times where we change our estimates. So we might say, okay, we don't think that it's going to last for as long as we initially thought it was. So, or in this case, I guess this example, we're going the other way. We think it's going to last for longer. So we initially set up this machine. We said it's going to last for 5 years. Now we've decided, I think we're going to push it out to 8 years. So then, but then notice your residual value is going to change, because if you could trade it in after 5 years, it's going to be worth more than 8. So then we have a change in that depreciable base, because again, we've got to subtract. So we take, okay, what's our book value as of the day we decide to make this change? So that includes our year-to-date depreciation. Then we subtract out our revised book value. So then this says, okay, that's what we're going to depreciate over the remaining 6 years, and then we calculate out a new depreciation rate. We could also change which method we use. So say we are using double declining balance method, and we've used that for 2 years, right? Is that what it tells us in there? And then we're going to switch and go with straight line for the remainder. So we look at it to say, okay, we've already depreciated out 160,000 using our double declining balance. We've got 90,000 left. We think there's a $30,000 residual value, and then divide that by the remaining 3 years and just depreciate the 20,000 each year. So that's what our journal entry would be for. Then we could have error corrections where we realize that we made a mistake. Maybe we capitalized something we shouldn't have. Maybe we made a mistake in how we calculated the depreciation, and then we have to go back and correct that. So if it's a prior period adjustment, we would have to correct our retained earnings balance. If we were just correcting it on a go-forward basis, then we would not have to do that. So here they're saying we inadvertently charged it off to legal expense. We really should have set it up as a patent, and then we should have been amortizing it. So then this was incorrect. It's caught now, and we need to make these changes. And if we're now in 2024, all of that goes to retained earnings, and it's considered a prior period adjustment. And maybe it's an auditor who, I guess in this case, they tell us it's the controller, but an auditor could find that too and say, oh, hey, you guys did that wrong. You got to go back and correct these. Impairment, like I said, if we're looking at goodwill and some of those other type of assets that we don't amortize, oh wait, this is just impairment of value. We'll get to that type of impairment in another slide. So this is impairment of value. This is saying that what if we had a building that in this case, a building that got damaged by fire before it was depreciated, or something happened out in your warehouse and a truck caught on fire, or there was a tornado. So I mean, there could be things that happen we want to impair, due to that catastrophic event. We're going to reduce the value of that asset. Now, granted, hopefully you have insurance that helps cover some of that stuff, but some companies can be self-insured up to a certain dollar amount, in which case they'd have to write that off. If we have the assets that are held and impaired, the value goes down. So whatever reason they're held and used, we have to record that write down to bring them to whatever the true value of those assets are. So let's see. So property, plant, and equipment, we would have depreciation. And then intangible assets. So like I said, those are the goodwill and the trademarks and the trade names. They are not subject to amortization. So we're not talking about those ones yet. Whoops. So according to generally accepted accounting principles, our assets need to be grouped at the lowest level for which identifiable cash flows are independent of cash flows of other assets. And then we would then test for impairment if there was events that would indicate that our book value of these assets or this asset group could not be recoverable. So then we would, and I feel like the auditors would probably push to have some of that done if there was reason to believe. So here are some examples that it could happen. A significant decrease in our market values, a change in how that asset is used, or again, like we said, like a fire or something like that. If there's some sort of change in the legal factors, again, in our particular business that we're working in. So something that really is a significant change that we don't think that we're going to be able to use that asset like we were. Then we're going to want to look at it to see if we need to impair. So then we look at it to say, is the undiscounted sum of our estimated future cash flows less than the book value? So if it is less than the book value, then we would consider it to be impaired. If it's not, then we would consider it not to be impaired. So if we want to take that loss and write down that book value, oops. So if we're going to use either the amount that we could buy or sell between, in the open market, so nothing like, no parents and subsidiary type deals, but outside to third parties. If we don't have that fair value determinable, we could estimate it or have it appraised, or we could use a discounted present value of those future cash flows. So those are all methods that we could use to figure that value out. And then we would definitely have to disclose it in our notes, because it's going to be relevant to a user of those financial statements to know what we impaired and why. So then here we've got an example that the business climate changed and a competitor's innovative product has kind of maybe, taken a toll on our market. So then we have $170 million book value. We estimate it is really probably closer to 150 million from an undiscounted future cash flow standpoint. So then we indicate that there probably should be an impairment taken. And then what we do is take it to the next step to say what would be the fair value of our factory's assets compared to the book value of our factory's assets. And then we would have a $35 million loss in impairment to bring those assets down to what they really are based on what we estimate our future cash flows to be. And again, this is still saying other than goodwill, but goodwill is also tested annually. So this either should be done annually, and again, a lot of times by the auditors, or if there was some sort of events that we felt like this really changes our business completely, so we need to look at it right now, and possibly write those down. So goodwill, again, this is something that we always do with goodwill because we never amortize it. So we always test it at the end of the year to see if it is impaired. So then what we do is we look at the reporting unit kind of as a whole, and then we compare it to, so we compare that reporting unit as a whole to the fair value of the reporting unit and see what the difference is. So if we look at that difference and we say, okay, it's $50,000, but then we go to our books and all we have in goodwill is in 30,000, then we're just going to take the impairment loss for the 30,000. We're just going to get rid of the goodwill. So we don't go below that. So we test it again annually, and then we would write it down as we need to. So let's see if we get to an example here. Okay, so we have the fair value of this company is 360 million. The book value of the company is 440 million. So our fair value is less than our book value, but our book value includes $100 million of goodwill. So our book value is $80 million overstated. So we need to reduce the value of the goodwill by that 80,000. Again, that would leave us 20 million in goodwill, that would stay on the books. Assets that are to be sold, again, like we had that on a previous slide, those are not depreciated or amortized. They're reported separately on our books. And then if we see that the fair value less the cost to sell is less than the book value, we would impair those as well to bring them down to what we actually think we could sell them for. Okay, then our next category is after we have these assets on the books, sometimes there's expenditures like a couple years down the road that we have to determine, are we going to capitalize those expenditures or are we going to expense them? So if we capitalize them, they're going to either increase the existing assets book value or we're going to create a new asset, and then we're going to then have to depreciate that out. If we expense them, then we're going to just charge them out into expense in that current year. So if they can impact our future benefits, then we could increase our useful life, or if they increase the useful life, then we could charge that out as an asset. If it makes us more efficient by increasing the quantity that we produce or decreasing cost, it's more cost efficient, then we can capitalize it, or if it's going to increase the quality. But a lot of times companies will say, hey, if it's under $1,000, we're going to expense it because it's not worth having, a ton of these assets that are minor on our books. So, again, there's always a materiality. So repairs and maintenance they just maintain the current existence of that asset. So if you have a truck and it's acting up and you take it to the shop and they put on new tires and new brakes, that's just repairs and maintenance. It's not increasing the value or increasing its production level. Now, maybe if it's something more major, like this example here, we're adding something to the delivery truck. So we add a refrigeration unit to it. So now all of a sudden we are able to change the nature of that truck and ship refrigerated items. So then we could capitalize that. Improvements, again, it's either going to be they should be capitalized by increasing the book value of the asset and then depreciating that over its life. So that refrigeration example, we would add that to the value of the truck and then we would depreciate it out. Then here they just give us a little summary of if we are getting rid of old equipment, getting new equipment, that would be a substitution of those assets. We still take the old one off the books and put the new one on the books. We could capitalize the new cost and it could be directly either to the asset itself or we could have it to a related asset account, but that original cost and accumulated depreciation is still on there. Or they, I guess, and I haven't seen this done very often, but supposedly you could then just leave your asset on the books as its historical cost and then just reduce accumulated depreciation. That would be another way. Your net book value would still go up. It's just a different way to record it. So then here they give us an example of rearrangement, which would maybe be out there in the factory, you're making things more efficient, or you're rearranging the offices. And again, that can be thousands and thousands of dollars, though. So that could be something that we might choose to capitalize. If we did not think it was material and it really didn't increase any future benefits, then we should expense it. And then again, in a little summary of what types of subsequent accounting acquisitions, after the asset's acquired, what we could do to it that may end up either being capitalized or expensed, again, depending on what it does to the future. And then this is for intangible rights. Sometimes we have to contact attorneys and either get like patents set up in the first place or fight if there's been infringement on our patents. So again, if it's to set it up in the first place, we could capitalize it. If we're just defending it from infringement, then we're going to expense it as it's incurred. Again, if and then it goes back to if we had no benefit received from that. Okay, so then that is our end under 11.